everyone, and welcome back from our long holiday week. Last week, hopefully you had a great holiday. We are back today. We're going to be talking about managing winners and losers and checklist of management. So last week we ended off with a trade entry checklist, and today we're going to look at the opposite side of things. So we're going to talk about when I might look at a trade and when I'm going to decide to either roll or close that trade as opposed to managing it as a winner. So today let's break it down with management, and there's three things that I like to look at when I'm looking at trades and whether I want to manage that or roll it, looking into it going forward. So let's go to the next slide here and we'll break these down. So the first thing I'm going to look at when I'm looking to either manage or close my trade is determining if it's a marked loss, and whether it is or isn't going to determine whether I'm going to roll that or not roll that or close the trade if I need to. Also, I'm going to be looking at the extrinsic value in the option that I have, and we're going to determine how to look at that, what some factors are that are important to know. And last but not least, we're going to be looking at rolling versus closing and some similarities and differences between defined and undefined risk trades, and when I might decide to roll versus close and vice versa. So let's get right into it with marked losses. So when we're talking about marked losses, basically what we're talking about is a loss that's unrealized. It's not something that I've locked in. It's not something that I've closed or rolled into a loss. It's something that's just marked on my P&L page, on my portfolio page. I might just see it as a loss. And one thing I want to point out is something that comes through the support channel pretty often, and that's marked losses on out-of-the-money options. So let's say that I sold a 90 put for $2 here, and the stock price is trading at 100. So if implied volatility increases, that means that the option prices are increasing. So let's say a couple days later, I see that that same option that I sold for $2 is now trading for $3, even though the stock price hasn't changed at all. So what I'm going to see on my portfolio page is a $1 or $100 loss. So what's important here is to understand that my option is still out of the money. So even though I'm seeing a marked loss on this trade, at expiration, I should see a $2 profit. So as long as this option stays out of the money, regardless of what happens with the implied volatility, eventually this option will expire. So if it expires out of the money, so for the puts, an out of the money put is going to be below the stock price because that gives the option owner the right to sell shares. So if they can sell it in the market for a better price, like at 100 as you see here, the option is going to expire worthless. So if I sold it for $2, implied volatility can increase all it wants, but as long as this option expires out of the money, I'm going to be able to keep that original credit of $2 and I'll see a profit on that. Another thing to consider here is, let's say implied volatility doesn't increase. Let's say it stays the same, but if the stock price gets closer to the option, so let's say the stock price actually drops down to 95. I'm still going to see that my option is probably worth more as long as there's not a ton of days that have leaked out of that option. I'm probably going to see that the option is still trading for more than what I sold it for, so I will still see a marked loss in that case. But again, as long as the option stays out of the money, and in this case with puts it would be below the stock price, with calls it would be just the opposite, so it would be above the stock price. But the key here is that if I see a marked loss on an out-of-the-money option, I'm not going to do anything at all because that option is still out of the money, and at expiration, regardless of what I might see fluctuating in my marked loss, as long as it stays out of the money, I'm going to see that profit at expiration. So that's the very first thing I'm going to consider when determining whether to roll or close a trade. On the next slide, we're going to break down extrinsic value, and we're going to talk about a little bit what we're looking for and what sort of things might trigger me to roll something or close something. So when I'm looking at managing trades and closing trades, I'm going to be looking at extrinsic value. So let's say now I've got an in-the-money put. So I sold the put at 55. Let's pretend the stock was at 60, but now the stock has dropped to 50. So that means that my put is in the money because, again, a put is the contractual right to sell shares. So if someone can sell it at 55 and the stock's at 50, now that put has intrinsic value. It has real value, and it will have real value at expiration. So one thing we know about the value of the option is that we can always calculate intrinsic value. So if the stock price is at 50 and I sold a put at 55, that means that I've got $5 of intrinsic value. So if I can sell the shares at 55, even though the stock is at 50, that gives me 5 points or $5 of intrinsic value. So if my put is trading for $6.50, and I know that I've got $5 of intrinsic value, that must mean that I've got $1.50 of extrinsic value. So if I've got 30 days till expiration here in this example, this is something that I might want to hold on to personally. So I still have $1.50 of extrinsic value, and again, at expiration, options are going to be trading for pretty much purely intrinsic value. So this $1.50 is still value that I can reduce my cost basis with as these days go by and we get closer to expiration. So looking at this same exact trade, now let's say I'm only at 5 days till expiration. So here you can see the option is trading for $5.25. I still have 5 points of intrinsic value, and since it's trading at $5.25, that must mean that I've got 25 cents of extrinsic value, because option premium is simply intrinsic plus extrinsic value. So now I've got 5 days till expiration, we're getting close to expiration, and I can only really reduce my cost basis by another 25 cents here. So now I might consider rolling or closing the trade, depending on what my assumption is. If my assumption is still the same, so if I sold a put, that means I'm neutral to bullish on the trade. And if that is still the same, then maybe I would roll it to the next expiration. But if I'm not and something's changed, maybe I would close it at this point, because that would reduce my additional loss if it keeps going down. And I've only got 25 more cents of extrinsic value to capture. So these are two different scenarios. And the point here is that I'm going to look at extrinsic value, and the more extrinsic value I have personally, the less likely I am to manage that specific trade. So moving along to the next slide here, we're going to be talking about another factor, and that is determining whether to roll versus close a trade. So you'll hear it all the time. It's really hard to determine when we're deciding whether to roll or close. And to tell the truth, it's going to be very subjective to each individual trader. And we're going to break that down here. So when we're talking about defined risk trades, our management opportunities are low. And that's because we like to roll positions for either even money, so $0 debit or credit, or we'll roll that for a small credit. And the reason we only roll for a small credit or even is because if we roll for a debit, number one, we're reducing our original profitability, so we're not helping our cost basis at all, and we're essentially entering into a trade that has a lower probability of success. So again, when we're rolling a trade, if you missed a previous whiteboard on rolling, it's a great segment. I would definitely check it out. I kind of break it down. But when we roll a trade, essentially what we're doing is locking in a loss, and we're opening up a brand new trade in the next expiration. So that's something that we want to consider when we're discussing whether to roll defined risk or undefined risk, or roll at all. So again, with defined risk, since we have that long option battling against our short option, our management opportunities are low. So it's going to be pretty hard for us to roll for a credit or even with defined risk trades. However, with undefined risk trades, since we don't have that long option offsetting our credit that we would receive, we can pretty much do whatever we'd like. So our management opportunities are going to be very high. So I can take that same exact strike and look further out in time, and I know that I'm going to be getting a credit for that roll because of the fact that there's going to be more premium in the longer dated options. So when I'm talking about undefined risk trades like we just saw with the naked put, I know that I'm going to be able to roll for a credit regardless of what situation I am in, and for that reason my management opportunities are high. Another thing to consider is losses. So with defined risk trades, our loss is known, it's defined. And with undefined risk trades, it's unknown. So although if I sell a put, I know a stock can only go to 0. If I sell a call, the stock can go to whatever. There's no cap to the upside with stocks. So for that reason, my loss is unknown. So it's really going to come down to the individual trader here to determine whether they're comfortable holding that loss or they want to roll into the future for another trade. And with defined risk, another reason why we might not look to roll is because our loss is known. So if we enter a trade and we know what our defined risk loss is right from the get-go and we're comfortable with that, we might consider just letting the trade play out, let the probabilities play out, and just consider it a loss if it doesn't work out for us and move on to the next trade. So when we're talking about rolling versus closing, With defined risk trades, we're normally going to close them unless the trade is on the dance floor. So if you hear the term on the dance floor with a defined risk trade, essentially what we're talking about is when the stock price is right on the short strike. So let's say I've got a short put spread where I sold a 55 put and I bought a 50 put. So that would be a short put spread, and the only time that I'm really going to be able to roll for a credit is when the stock price is right around 55, which is my short put. It might be a little bit higher, a little bit lower, but since it's right around that short option and the options at the money have the most extrinsic value, if I look to roll that spread with the same strikes into the future, I'm going to have a better chance of getting that roll for a credit. So normally we're going to look to close just because that's pretty hard to happen, especially when we're closer to expiration. It's going to be pretty rare that we're on the dance floor, but if we are on the dance floor, then maybe we will look to roll as opposed to close. And when we're talking about undefined risk trades, when I'm determining whether to roll versus close, it's really risk profile dependent, and it's also account size dependent. So if I've got an in-the-money option, I know plenty of traders that will hold that in-the-money option and they'll roll it continuously for a credit until they're eventually correct. However, we have shown studies that closing a trade at 2x credit received can also be optimal to reduce our max loss and increase our probability of success over time. So when I'm saying 2 times credit received here, I'm talking about the original credit that I received for that trade. So let's say I sold a put for $1. If I were to follow this rule of 2 times credit received, I would be closing that put when it was worth $3, because that would be showing me a loss of $2 since I sold it for $1. And that would be 2 times my original credit received. So I would see a loss of $200, but I would really be buying back that put for a total of $300. But since the $1 credit offsets that max loss, or the loss that I am realizing at that certain point in time, my $3 loss becomes a $2 loss, which is that 2x credit received. So that's something that we just recently discovered here, that we can go by if we want to close the trade rather than roll it. However, if we are risk averse and we want to just continue that trade and we don't really care about the account being hit at that certain point in time, maybe we'll keep rolling it into the future and hope that eventually it will go our way. One last thing I want to say about this is that it's really going to depend how deep in the money that option is as well. So if we have a super deep in the money option that we've sold and we can only roll it for a very, very small credit, maybe it's better for us to close that trade and move it to a different brand new underlying where our opportunities are going to be more fruitful. So it's really going to be depending on the actual trader here, and it's going to depend on risk profile and account size as well. So this has been the management checklist here. Let's get to some takeaways and we'll wrap it all together. So closing and rolling decisions are subjective. So I know it's not what everyone wants to hear, but at the end of the day, everyone's got a different risk profile, a different account size, different options approval, whether you can trade undefined risk or defined risk. So really, it's going to be dependent on the individual trader, but hopefully this information helps. Secondly, marked losses can turn into profit by expiration. So it's something I'm going to be very aware of. So if I see a loss, I'm also going to double check that my option is not in the money. So if it's not in the money and it's still out of the money, even though I see a marked loss, I know that at expiration, if I sold that option, it's going to be profitable as long as it stays out of the money at expiration. So if I see a marked loss due to the stock price getting closer to my strike or implied volatility increasing, I'm probably still going to hold on to that option. And lastly, closing undefined trades at 2x credit received has shown to be optimal in terms of wanting to close the trade as opposed to rolling it continually into perpetuity. So if I want to close a trade at some point in time and I want to establish a mechanic, we did have a market measures that showed that closing at 2x credit received, it was the most optimal over a number of occurrences. So this has been the management checklist. Hopefully you enjoyed it. If you've got any feedback or questions at all, shoot me a tweet at DoTraderMike, or you can shoot me an email at support@do.com or support. And until tomorrow, we'll be here at 3:15. We'll see you then.
Thanks for watching. If you found this video useful, give it a thumbs up or share it with a friend. Click below to watch more videos on this subject or subscribe to our channel. For even more data and research, check out